Our class tonight is sponsored by Alvexo, A-L-V-E-X-O. You can find them at www.alvexo.com. They are what the world's leading regulated Forex and CFD provider. And you know when you're trading with a regulated company that your funds are segregated and they're safe, and all their actions are transparent. Now, Alvexo is one of the most well-known providers in the marketplace. They offer 3 different types of platforms you can trade from. You can use their web trader, which just means you can log on online from anywhere at any time and trade your account. You can download the MetaTrader 4 platform and adjust it, modify it, and even use it to launch some of your own alerts and signals or robotic trading. And lastly, they offer a great mobile platform. They also give all of their traders free up-to-the-minute signals directly on the platform that have an 88% accuracy. They're free of charge, and they're issued twice a day. Now, tonight's class is being recorded, and you can access a copy of the recorded class in about 24 hours by going to investing.com, where you enrolled in the webinar, and go under the Education tab, and then go to Webinars on Demand. Now, the other thing is, while you're in class, you can go to Alvexo at www.alvexo.com and open up a demo account. There's no credit card or deposit required, and all you have to do is pick an email and a password, and you can start following along and using their charts to decide on retracements and reversals and follow along in our class. Now, because Alvexo is a regulated provider, I am required to give you a risk warning before we get started. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. So let's get started with retracements and reversals. Now, in order to understand and to locate and not to panic in the markets when a retracement or a reversal is occurring, one must first hold on one second. I get this guy writing all these things. He can't hear me, so I got to type him back an answer. Sorry about that. One must understand a trend. One must understand that price doesn't move in a straight direction. When you talk about an uptrend or a downtrend or a sideways trend, it's the overall movement of price, not did it go up and then straight up, because price doesn't move. If you see price just soaring straight up, there's something wrong with that price movement. Price should move in peaks and valleys, push and thrust, or thrust and ease, thrust and ease, thrust and ease, thrust and ease. And that gives you a well-developed channel. Now, when you have this, okay, you won't panic when price begins to move against you. And you'll be able to understand whether the markets are retracing or reversing. And if you can get yourself to believe that a retracement is a good thing, you'll be more comfortable trading. So the ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. And this is why the focus of today's webinar is to provide you with the information and knowledge needed to accurately determine whether an asset's trend is forming a retracement or preparing for a reversal. Because too many traders exit the market too early because they think the market is reversing, only to lose a large movement in their direction. So let's start off with some general definitions. Okay. Retracements are momentary reversals that often occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset's price action. So as you can see in the picture on the right, there are a couple retracements that take place and occur throughout a prolonged period of time. Now, push, ease, push, ease, push, ease, push. Okay. Now, this would not be a retracement, but when price moved up here and came back down to this level, you weren't sure at that point. But then it did not exhibit the rules of a retracement and gave you a full reversal. But remember, a retracement is simply a momentary or short period reversal. Okay. It is the ease between the pushes. It's the peaks between, or the valleys between the peaks. And they're not cause for panic. Whereas a reversal are temporary changes in asset's trend that occur over a short period of time. Often these reversals can last minutes, hours, or days. It just depends on what time frame you are utilizing for your charting solution. Reversals are oftentimes drastic and do not represent a long continuation of the opposing trend during the asset's price action like seen with a retracement. In the picture we're going to see on the next screen, you can see examples of what reversals look like. And look at the time frame on the charts and notice how they occur during short periods of time. Now, there are some ways, some general rules of thumb, because everybody seems to want rules. They want definitions. They want to know, how can I tell off the bat that it's a reversal or not a retracement? Well, there are some general rules. No, let's back it up. There's some general guidelines, but most of it comes from understanding and looking at a price chart. Okay. Now, things we should look at are number one, volume. Volume will give you the key, because if it's a retracement, which is usually profit taking by retail traders, small blocks of trades, a reversal might be occurred when we see large blocks of trades because the institutional investors selling out or getting out of that position. Chart patterns. Few, if any, reversal patterns usually are limited to candles in retracements, whereas double tops, triple tops, double bottoms, triple bottoms, head and shoulders will signal a reversal pattern. Okay. Fundamentals. Usually, there's been nothing in the market, nothing in news, headlines, economics count that has sparked anything to happen. Where a reversal could be indicated because we've seen a change in the overall speculation. Maybe an inflation report came out and it was very, very high. Maybe jobs report missed its data. Maybe Donald Trump did something crazy again. Maybe North Korea started threatening the US again. Okay. These would be fundamentals that would change the market direction. Okay. Now, we also look at recent activity. Okay. Usually a retracement will occur right after large gains. Push, ease, push, ease. Okay. But a reversal can happen at any time, even during otherwise regular trading. So when you don't see this push and ease, okay, and so when you see a nice push, you should be expecting that ease. Now, We also have candlestick patterns. Things like spinning tops or dojis. These are candles of indecision. They tell you the markets are waiting to make a decision. So usually this gives you the retracement, where we have strong bearish and bullish engulfing candles, three black crows, three black soldiers, and other similar patterns that give you full-on reversal signals in candlesticks. But those are the general things you're looking for. Most of it would be noticing the price movement within your chart. One of the best rules of thumb that I use is looking for my support and resistance levels and looking at my trend line. Because I would expect price to push up off my trend line, ease back down to my trend line, push back up off my trend line. So whenever a price reverses, most traders and investors are faced with a tough decision because you only have three options. And remember, a reversal is really what? A retracement is really what? A short-term reverse. So you have three options to yourself. One, hold throughout the sell-off, which could result in a large loss if the retracement turns out to be a larger trend reversal. Sell and rebuy if the price recovers, which will definitely result in money wasted on commissions and spreads. This may also mean you missed an opportunity because you can't get back in the markets fast enough. Or sell permanently, which could result in the missed opportunity if price recovers. So by properly identifying the movement as either a retracement or a reversal, you can reduce costs, limit loss, and preserve gains. So traders have an expression for attempting to pick a market top or bottom, and they call it trying to catch a knife. As the expression implies, it can be downright dangerous and is not normally recommended. Now remember, retracements are healthy. A market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets higher. Now, again, think of yourself. You bought into an asset that's moving up. Well, you bought, okay? You are holding a long position. So you're one less buyer in the market. The next guy bought, the next guy bought. Some point, you've run out of buyers for a minute or two because the guy who bought earlier said, you know what? I think it's going to continue up. Let me buy again. So it needs that retrade. Or the guy who was looking at buying saw a price move up and say, you know what? That price is too high for me to buy. So when it dips back down, usually using a support or resistance level, he'll say, okay, that's a good price. I'm going to enter the market now. And he'll buy into that market. He's buying into that uptrend, but he wants to buy at the best price. Or say he goes and looks in euros at 123.50. Euro's been moving up steadily. He says, well, that's a good price. I think the market will still move up, but I'm not a fool. I'm going to place a limit order to buy it when it dips back down to 123.25 because he knows the market doesn't move in a straight direction, and he's got a buy order sitting out there waiting to be executed. He's just waiting for that dip in price. Well, if you got 100 people dipping because there's a strategic support line there, okay, it's going to dip down. When all those buy orders are executed, it's going to push the price right back up and move back up into its healthy trend. So remember, a retracement is a component of a healthy trend. So when demand dries up, price begins to fall and causes the chart to head south. This causes security to become more appealing to prospective buyers who believe the asset has potential to move higher, but we're waiting for a better opportunity. As the price becomes more appealing at a lower point, these new buyers step in, creating demand, and once again, the price begins another leg higher. Okay. So what if what I have just described is a retracement? Retracements are healthy functions of a solid trend, and they are the proper time to enter a position on a trending asset. So in other words, you've done all your evaluation. It doesn't matter where you are in a trend. You got an alert. Your fib levels got crossed, or your Bollinger Bands did what it did, or MACD gave you a buy signal, and you want to buy into that market. But you don't want to buy at the top of the market. So the proper way to enter it is, okay, what price will I enter that market? Okay, so you see that next support line, you say, if it bounces off that support line, when it bounces down, I'll buy, because you're buying into the uptrend. You just want to buy at the best available price. So you can see that after a retracement, the asset was unable to push to a higher high. Instead, the security rolled over and created a lower high. A lower high is unhealthy, but it's not the end of the bullish trend. It is possible that after setting a lower high, the asset could retrace again, never setting a lower low, and then push up to the previous high and to a higher high. The nail in the coffin of a bullish trend is the establishment of a lower low. Once the lower low is in place, your trend is over, and this is called a reversal. So in other words, we saw price moving up. Price for some reason could not continue up and ease back down. But what it did is it formed a lower low, too low for that retracement, because what it did is it broke the trend line and it formed a lower low. That's telling you that your trend has ended and you're going into a reversal signal. Okay. So a lower low is what is significant. Lower highs are not that significant. It is forming that lower low. And you can see that with your candlesticks. Okay. And each time it forms another low, we could be assured we're moving into a reversal. And this is the point in which you want to exit the market, because the retracement has moved into a real reversal. So if you think of a retracement as a small reversal, and a reversal comes from a retracement. So the market's moved up, it's reversing, moving slightly down, but that's just a retracement. Then that retracement moves into a full reversal. So let's add some guidelines. Reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reverse occurs. Now, that doesn't mean that the market flips itself over automatically. Okay. On our chart over here, it looks like the market moves up, hits a reversal point, and moves down. The market could move up and then move into congestion and stay sideways in congestion and bounce around a little bit and then move down. But it's telling you when it reaches that reversal point that that uptrend or that trend it is on is over. Doesn't mean it's going to fall. Remember, when you're using indicators, overbought markets or oversold markets can stay there for a while longer. So it's telling you that the current trend has ended. It's not necessarily telling you the new trend has begun, because the markets don't just die on you. So let's talk about what you should do. So remember, we talked about there's three possible scenarios. You have three options. When faced with a possible retracement or reversal, you have three options. One is, if in a position, you could hold on to your position. This could lead to losses if the retracement turns out to be a longer term reversal. Now, if you use the proper trading plan and set up your buy or your position with a proper stop loss and a proper entry point, exit point, and you had decided what your acceptable profit would be, okay, and the market's already made your profit, okay, you can move your stop loss way up so that if the retracement turns out to be a longer reversal, you don't lose your capital. You don't lose your profit. Okay. You could close your position and re-enter if the price starts moving with the overall trend. To me, this is, if you're worried, if you really can't decide, is not to re-enter the market, it's to get out of the market, take your position, take whatever profit you have, or even if small, and just get out of the market. Okay? Because I don't ever believe in re-entering once a trend has begun. A trade is a trade, and when it's over, it's over. You can find another trade in that asset, but if you start entering and exiting markets every time you got worried, again, your spreads would eat you alive, and the opportunity to get back in the market. If the euro was moving up to 123.50 and you had entered the market at 123, you had a nice profit. You got back out when the market retraced and it was down at 123.10. So you had 10 pips, but by the time you covered the spread, you got out and you made a couple cents. But by the time you realized that you could re-enter the market, it was already back up to 123.25, covering the spread. You're at 125.30. You're just wasting your money. Go away, find something else, find a new opportunity. 3, you could close permanently, and this is, for me, the best. If you're not sure, just close permanently. This could result in a loss if the price was against you, or a huge profit if you closed at the top, depending on how you structure your trade and what happens. And this is one of the reasons why you put a stop loss and a limit level, because you decided before you entered the market what your target price would be, where your risk could be, and everything else. Now, like I said, if the market has been moving in your favor and that uptrend is continuing, you've made profit, you can use trailing stop losses. You can use different stop loss exit points. You can do lots of things to limit your risk. But be prepared, because a reversal can happen anytime. Choosing the best option isn't always easy, and sometimes, if you're not prepared, just in those few minutes while you're deciding what to do or you're away from your computer, can turn into a nightmare. So if you're not using proper stop losses, risk management, money management, then you're making a terrible mistake anyway. Because the worst can happen if you're using your proper order entries and you've got your proper level set, the worst can happen is you get stopped out with a small loss. Okay. Now, there are several tools that are very reliable to help you spot a retracement and to help you see if that retracement is actually developing into a reversal. So Fibonacci retracements are a great tool. Pivot point support and resistance levels, trend line support and resistance levels, chart patterns, and volume. Now, Fibonacci retracements are an excellent tool for calculating the scope of a retracement. They are widely used in the foreign exchange market, but are also used in the stock market. To use them, simply use the Fibonacci retracement tool available in your charting software and draw a line at the top and the bottom of the latest impulse wave. Fibonacci retracements are excellent tools for calculating the scope of a retracement. They will also help you predict where if it breaks through each fib level, and you could say, I'll let it go to the 50% fib level. If it breaks through there again down to the 61.8, I'm out of the market. Okay, so Fibonacci retracements are excellent tools for calculating the scope of a retracement. They are most widely used in Forex. Okay. To use them, simply use your fib retracement tool and pull a line from the swing low to the swing high. In most cases, retracements will stay above the 38.5 or the 50% level. If the price moves below these, then a reversal may be forming. Pivot points. Pivot points come from pivot point charts or support and resistance levels. Pivot point levels are also commonly used when determining the scope of a retracement. Most traders look for lower supports at the R1, R2, and R3. If these are broken, then a reversal may be forming. Now, if you don't know what a pivot point is, you can get these from what's used called a pivot point calculator, or you can go on any site that's offering technical analysis and pull up the pivot point charts, and they'll give you your support and resistance for 3 levels above and below, and you can add these onto your charts. And in this case, if you saw when price is retracing in an uptrend, it will most likely fall to its next support level and then bounce off of it moving back up. If as long as it stays above that support level, then you're pretty confident that that's a retracement. If it breaks that support level and falls down to the next support level, okay, you got to get a little bit worried. If it falls down to your third level, you should be out of the market. So here on this chart, you can see we've got our pivot point charts on here. And so we have our support level here, our support level here, our resistance level, resistance level, resistance level. They came directly off the pivot point calculator. You did nothing. You just drew them on your charts, taking them off the pivot point on a technical analysis site, or use the pivot point calculator and put them in and let them all calculate for you. So we see as price is moving up, it comes up to its next resistance level. It is not able to break that resistance level, which is a little bit worrisome, and it falls back down to the support level. But we don't need to panic because it hasn't broken that support level yet. So it's still holding in the form of a retracement, but the markets are consolidating here. Okay. Now, at this point, when I see that consolidation, I don't see any well-developed trend, so I would be exiting the market. Now we see it break that support level, which becomes our resistance, and it falls back down to that next level. Okay. I would be out of the markets entirely, but you might want to, when it bounces off, enter into a buy position, a new, completely different, and as it breaks that upward level, but again, it moves into this congestion, and then here we see it come back down to that resistance level, break through, and it moves into a hardcore downtrend. So we can use these. I use my support and resistance levels as support moving up, and I would expect my trend to either touch the next resistance level and then eventually break through it. And if it falls below my support level, it's telling me to get out of the markets. Then we also have, now the thing is, you can combine all of these on a chart very easily. So we have also trend line support and resistance. Trend lines should be the first thing you're putting on a chart. And as price is moving in a trend, as I said, push and ease, push and ease, push and ease, push and ease. Your trend line underneath the price, if drawn accurately, should never be violated. Because once it forms a lower low, okay, then you are worried about not a retracement, but a full reversal. So as long as price is moving up and down, push and ease above your support trend line, you're pretty confident that it is a retracement, not a reversal. Now, in an uptrend, you're going to draw your support line underneath the prices. In a downtrend, you draw it below. But to do this nicely is you could draw an upper trend line as well as your support trend line, your price underneath, and form you're basically a trading channel. As long as price is moving in there upward and downward, you're pretty fine. Finally, if a major trend line supporting the larger trend is broken on high volume, then a reversal is most likely in effect. Chart patterns and candlestick patterns are often used in conjunction with these trend lines to confirm reversals. So in other words, anytime we saw price break through, anytime we see price break through this trend line, okay, we would then consider it an exit point and probably a reversal, or that trend is no longer good. Okay. And if we look at our volume on the bottom of our charts, that will help you. If you see price break below that trend line and volume soars up, that means there's lots of sellers selling out of that asset. That means you should be doing the same thing. So we can combine the trend line, support, and resistance line, Fibonacci's all on one chart. And I'll show you that in a minute. And then we can also use chart patterns. And chart patterns have an established definition and criteria, but there are no chart patterns that tell us 100% certainty when a security, where a security is headed. After all, the richest man in the world would be a trader in that case, rather than an investor. The process of identifying chart patterns based on this criteria can be subjective in nature, which is why charting is often seen as more of an art than a science. But one of the best patterns in a chart to tell you trend reversal is called a head and shoulders pattern. And you can see that developing in your chart. And the nice thing about patterns, they also have calculations that will tell you where to exit or enter, where to buy, and how far your target should be. Now, two of the most popular chart patterns are reversal and continuations. A reversal pattern signals that a prior trend will reverse upon completion of the pattern, while a continuation pattern signals that the trend will continue. Once the pattern is completed, these patterns can be found across any time frame. So ascending and descending and symmetrical triangle are a good way. When we see price getting congestion in the center, we see a triangle develop on our charts, and we see the price developing into the center of this triangle, the congestion, we can have a breakout or breakdown. If we have a breakout in the direction of the current trend, that's telling us the trend will continue. If we see a breakout in the opposite direction, then it's telling us that we have a reversal. So remember, technical analysis is the study of historical price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least and possibly a more important determinant of price than fundamental factors like earnings, revenue, and profit, or central bank action and inflation. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental change. And third, the relationship between price and time is linear. Different strategies have varying degrees of success depending on the market is in a bigger time frame. Technical analysis of a strong uptrending market will show that basing patterns are frequently broken to the upside, forming a stair-step chart pattern or a trend, push and ease, push and ease. Triangles are among the most popular chart patterns used in technical analysis since they occur frequently compared to other patterns. The three most common types of triangles are symmetrical, ascending, and descending. So a symmetrical trading strategy is one that is simple and effective enough to let you gain from the momentum without staying a second longer than necessary. A strategy relies on a pattern that, no surprise, is called a symmetrical triangle. Okay. When we see this form and price breaks out of that triangle to the upside, then we have a continuation. If it breaks out to the downside, we have a reversal signal. Now, let's go to some live charts and take a look at some of these. Hold on, let me pop it up. Okay. So as we can see, this is nothing. This is a chart of the euro, a current chart and 1 hour chart. And these are just lines of support and resistance Fibonacci levels that I already have on the chart. But if you see price smooth, push, ease, push, ease, push, ease, push, ease, a well-developed trend. Now, what happened here is price pushed down, and now it formed a higher high. And look at that. This reversal, this retracement became a full reversal. Okay. But push and ease, push and ease, push and ease. And we could have seen it here. We couldn't have seen it here to exit the market. But once we saw it here, bounce off and move above our fib levels, move above our support levels, and at the same time made higher highs, then we know that that downtrend was over and we were moving into an uptrend. Okay. Now, here we have a nice simple chart where we have our Fibonacci retracements on here, as long as a falling wedge, a well-developed pattern, and we're looking for a price to hit this fib level at the 61.8, and then move up as a breakout and to continue this uptrend that it had previously formed. So we saw a price move into this uptrend here. Okay. We had push and ease as a move to the downtrend. Then it broke above and formed a higher high, continued up, and now it is easing and is formed into a falling wedge. And we're expecting it to bounce back up and to continue up in this fashion. But that's what we're hoping for. Again, price action is the only thing that's going to determine this, but we're hoping to make some evaluations. Okay, so we can see on here on Bitcoin dollar, look at this, the perfect waves. Push, ease, push, ease, push, ease, push, ease, reversal here, push, ease, and we're expecting these movements. We have our Fibonacci levels on here on our Bitcoin, and we have this beautifully well-developed channel with all of our waves in place, and we've now got our retracement, and we're looking for it to break, not be able to break above that support level and to fall back, break above that resistance level, fall back to the support, but then we're expecting it to bounce up to form waves 3 and 5. And then here we have another chart, and we have both our Fibonacci levels on here as well as having our support and resistance levels on here, and we have a development of a triangle here. We just got the breakout of triangle in the last candle, and so now we can expect the price to break up. But look at this, we have push, ease, and we have our 5 waves also in our price movement, and then we have price falling down, push, ease, push, and now is simply determining in each case whether these are reversals or retracements. So by combining several of these tools together, we can successfully not just enter the markets, exit the market successfully, but stay in the markets, because look here, you wouldn't have wanted to enter the market here and then panicked and sold here. You would have wanted to run it all the way to here. Okay. So when you understand that it's a retracement and don't panic, you'll get the most profit out of each trade. If you would have said, okay, I'm going to enter here, I'm going to set my reversal here at the last wave, my stop loss, and you could have just let it ride. Okay. But it's convincing yourself that retracements are healthy, and the retracements can flip into reversals, so that you're aware of that healthy retracement, but ready to react when it moves into a reversal. So thank you very much for joining us. If you go to www.alvexo.com, they have a great deal of education materials, and they have all types of videos that will explain each one of these legs step by step and all the waves of a part, because you have to first understand what an uptrend is or what a downtrend is. You have to understand the parts of a trend and the cycle of a trend. Then you have to understand what support and resistance are. You have to understand how you combine volume and slowly build your trading foundations, okay, so that you understand and can interpret a price chart. So have a very good night. Thank you for joining us. And again, give Alvexo at www.alvexo a chance and see if you can learn how to use retracements properly. Good night now.